Is Salesforce or CRM stock, as it's known in the markets, a good long-term buy today after it's been down 24% year to date, as you can see here? I wanted to keep this 5-year graph in because it just shows, even after the 24% drop, how this would have been a good investment over the last 5 years, even accounting for the multiple contraction that we'll look at in a moment. But recently, this stock has fallen, as you can see, 24%, which by all accounts isn't a bad result relative to its tech peers. Salesforce stock has actually weathered the storm in growth, and tech stock fall out quite well. And the business has also performed during the period where other tech companies have actually struggled. And you could look at this as either a point of strength for the stock or a point of weakness in the stock, that CRM's time of peak bearishness is yet to come. However, with CRM, I think the fact that they've been around in the public markets for over 15 years and been improving as a business consistently over those 15 years, putting up really just continuing growth of a steady 25% CAGR, doubling the business every 3 to 4 years, I think that's really helped with investors' confidence and sentiment, just that track record of proven results and performance in the face of this period of uncertainty. And let's just be clear, in this period of free falling in some stocks, we'll just touch on that. We are in what I would call maybe a historic bear market, especially in tech. And the free falling in a lot of these names has been driven by investor confidence rather than real fundamentals. I've got some names here, even I've got the indexes as well. You can see the QQQ, which represents a lot of the tech companies, down 20% year to date in just the first quarter. That's a huge drop for an index. The S&P also not doing well at 12%, but a lot of the biggest components in the S&P are now those big tech stocks. So it makes a lot of sense. And I've got obviously just a few names here. I could have added a lot more, but this shows you really how much these high quality tech names have been struggling. The likes of Netflix down 40%, Spotify as well, PayPal, Meta, and Alibaba, which was already beaten down, almost losing half their value year to date. And the reason why I say this is driven by investor confidence rather than real fundamentals is these businesses have not got 50% worse in the last 3 months. That's just not the case. And it's likely valuations got ahead of themselves in a lot of names, maybe even these names, but that doesn't mean the stocks aren't at good long-term value today, or haven't been in the past year or so even. It's probably also a good thing to point out that if you feel your sentiment changing and shifting with and at the same time as the market, you may want to evaluate why that is happening. Are you looking at negative news and short-term macro indicators, as well as stock prices just falling in general and losing your convictions? Or are you really analysing businesses and basing your opinions on fundamentals that have changed the view of what you expected from the business in the long term? Just a reminder to think about that, as that's what I am doing. After all, history has taught us that sheep in the herd don't tend to outperform the market averages, which is what I'm trying to do here. So back to CRM anyway, just keeping on the topic of free falling stocks at the moment and the bear market that we're in, the current valuation for CRM does look quite appealing when you measure it against the business's results and what they're giving guidance for, but it's not necessarily had a huge fall off. As we can see, it's currently selling at 10 times gross profit on a trailing basis, which isn't dirt cheap, isn't that expensive either if we look at where it's sold in the past. And then 24 times EBITDA, which in comparison to a 5-year average of 29 times EBITDA is a bit cheaper. But again, it's not like we're looking at Salesforce like we see with some other names and going, well, this is the cheapest it's ever been or been for 10 years or more. It's not necessarily at that territory yet. But that may be to do with the business quality. If we look at how well Salesforce has done over the years, you can see here they've been the fastest growing enterprise software company ever in the first 20 plus years since they've been founded, even beating the likes of Microsoft and really by far and away beating the likes of Oracle and SAP. And not only that, Salesforce, as Mark Benioff says, is in a new paradigm. The world is in a new paradigm in the sense that there is a digital transformation going on in businesses all across the globe in all different industries. And businesses spend an investment into their technology infrastructure is increasing at a fairly rapid pace. And this feeds directly into Salesforce's business. If we think about what they now offer, they now have a 360 offering. They define as their Salesforce Customer 360, essentially a suite of enterprise software, CRM, which allows businesses to manage their business communications, customer relationships, sales and marketing, and analytics and things like that. So front end and back end solutions, thanks to all of the acquisitions that it has done in recent years. And due to these acquisitions and all of these different cloud offerings that they offer, sales, customer service, marketing and commerce, platform and data analytics, they see a total addressable market of around 250 billion by 2025. And when we think about how well Salesforce has done in competing with some of the incumbents in this industry, it's likely that they'll take the lion's share of this total addressable market. We can see here just on this graph how well they've done versus the likes of Oracle, SAP, Microsoft, and Adobe in the CRM space. They've managed to capture around a fifth of the market today, 20% market share versus the likes of Oracle and SAP actually dropping off. And this really reflects the quality of Salesforce's product offering. And another important part of this, which adds into the business quality, really is the nature of this large amount of 25 billion in revenues. As you can see here, over 90% of the revenues that they take in are on a subscription basis, right? Subscription and support revenues, essentially the customers paying through monthly or annual contracts to have access to their CRM cloud products, whatever they choose, whatever suite of products that they choose for their business, and they can have access to that at any time and anywhere. And so what's really positive about that from a Salesforce point of view is that 90% of their revenue intake is on a contractual basis, on a monthly or annual subscription basis, which makes it very sticky, gives it a low churn, and also importantly, makes it easier for them to forecast future cash flows. And so how should we think about Salesforce's valuation? I've got a DCF model here, and there's a couple of things that I want to talk through with the financials. Now that we know about the business, now that we know that where it's selling a traditional valuation metric basis, I want to talk a little bit more in depth about what we need to know about Salesforce when we're forecasting future growth and then also discounting back to the present day. And so you can see here we've got their impressive growth on a reported basis, that 25% year over year that they seem to always knock out. They also have pretty impressive margin expansion. EBITDA margins going from 6% to almost 12% in the most recent year. Free cash flow as well going from 1.6 billion to around 5.2 billion, which is all great. One thing you will notice though, I'm just going to highlight this area here, is there's a big deviation in the net income to the EBITDA and the EBITDA into the free cash flow. And although that's confusing to some people and some people see it as a red flag, I'd argue it actually creates somewhat of an investing opportunity, because most people put a tag on Salesforce and see that 5% net income margin or that varied margin year on year or the GAAP operating margin and think that they're not a profitable company, like a company that's doing 26 billion in annual revenue at an 80% gross margin isn't going to be a profitable company. And so what is driving that delta? And the delta between the EBITDA or the cash earnings, the non-GAAP cash earnings and the net income is essentially the amortization of intangibles. We've got some depreciation in there as well, but it is amortization of intangibles, which is their assets, their intangible assets being written down in value over time, just like a company with physical assets has to write down the value of their assets over time, and that gets accounted for in the income statement, even though it's not an expense that the company is actually paying on the revenue that it generates. So it's not a cash expense, and it isn't a reflection of the earnings power of the business, in my opinion. The other thing, and the reason for the delta in the EBITDA to the free cash flow and why the free cash flow is so high at 5 billion, that's almost a 20% margin, is because of this large amount of stock-based compensation that they do. So we can see here it's 10% of revenue almost every single year. And not just that, like we spoke about previously in the video, there's another dilutive aspect to their growth model, and that is acquisitions, which usually are done through stock offerings or swapping Salesforce stock for the company that they're buying, doing the purchase through stock. That dilutes the current shareholders quite significantly. And we can see the effect of both of those things combined, the stock-based compensation at 10% of revenue plus the acquisitions that they make. It's taken shares outstanding from 700 million to 974 million in just 5 years. So a lot of dilution there. But what we can do to try and assess whether this adds value to the business or not is look at all of these financial metrics on a per share basis. And so what I've done here is just look at their revenue per share and seen revenue per share gone from $11.99 to $27 per share in 5 years, which, don't get me wrong, is around 2.5 times. So not a bad net result. Not as good as the 25% compound annual growth rate that we've seen in just reported numbers, which implies that revenue will double every 3 years. So that dilution does have an effect on the revenue. We can see that the margin expansion has helped in the bottom line numbers. So EBITDA per share gone from 77 cents to $3.15 per share, which is somewhere near a 35% compound annual growth rate. So not as high as the 45% that's reported in the overall numbers, but still adds value to the business. And free cash flow per share, similar growth rate to the revenue per share. So we have to look at it objectively. It does create value in the business. This dilutive aspects in terms of stock-based compensation, quite normal in the tech business due to the competition for talent and management incentives. Also, the acquisitions that they make add a lot of value to their business. You just have to look at the acquisitions they've done in the past 5-6 years and where those companies are today. Also, the bottom line numbers improving quicker than the revenue numbers implies that they're finding operational efficiencies and cross-selling abilities through those acquisitions, so adding value, like we say. But they are still dilutive. So that means that we need to be a bit more clever in our forecasting of Salesforce and obviously factor in dilution in our per share understanding of the business, because at the end of the day, we are per share shareholders. And so what I've done here, just as a hypothetical example, trying to get an indication of how well priced Salesforce is today and whether the stock price should go lower before we look at purchasing into this company. And so I've got 20% growth going forward. Obviously, they've managed 25% over the last 5 years. Guidance is around 20%, and that's what management are aiming for. So I've kept it in at around 20%. I think they will be able to do it. Factored in some margin expansion, similar to what we've seen in the past on the EBITDA line. Net income you can more or less ignore. It's just there to show the dispersion between the three bottom line metrics there. It doesn't have any sort of correlation to the end result in this valuation, so you can ignore that. Free cash flow, on the other hand, does have an impact on the valuation, and as you can see, I've just taken what their usual cash conversion rate is. This isn't obviously taking out stock-based compensation, this free cash flow forecast, but we are factoring that in our dilution of the shares outstanding, which is 3% per year at the moment, the current run rate. And so I've taken two different multiples, one looking at the company from a free cash flow point of view and getting, say, a 5% yield on that free cash flow. Investors would be lucky to probably pay 5% for CRM in the future. So I've gone with that from a free cash flow point of view if you're looking at it at that perspective, and then a 25 times trailing EBITDA multiple on this line here. And what that gives us is an average terminal value, right? Just hypothetical at this point, saying that the business should be fairly valued around $328 billion as a whole business in 2026. And so when we factor in for dilution, which, like I say, 3% per year, does have a big effect on the intrinsic value, we get an intrinsic value for the business at around $177 billion today, which is close to where the market cap is. However, with the dilution, it gives us a fair value of around $156 per share, which implies that the stock has quite a way to drop, around 22% to drop before it gets to fair value territory using a 15% required rate of return. And so all in all, it looks like Salesforce, although it is a great company, at current prices, I think there may be better opportunities in the market for us to focus on right now. Not to say that Salesforce isn't a company we should want to own because of its quality. It's shown how resilient its investor base is and its business is in the current climate. So definitely a business to keep an eye on. There's just maybe some better opportunities out there and some more distressed names at the moment. But on the topic of Salesforce is going to be our deep dive for March on the Patreon. So go ahead and check out all of the deep dives we've done previously on there on Spotify and Mercado Libre. You'll also get access to this valuation model on there where you can plug in your own assumptions and also various other valuation models that we've done on this channel as well. So go ahead and check that out if you're interested. I'll leave a link in the description below. But apart from that, please leave a like on the video. Let me know in the comments below what you think of Salesforce. I had a few requests to do this video, so do let me know what you think and where I maybe am wrong on Salesforce at the moment. But until next time, good luck with all of your investments. I'll see you in the next video.